Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, coming at you from my office because I'm having technical difficulties today, and this hopefully everything sounds okay. Anyway, Todd, looks like you're in our studio in New York. How are you doing today, Todd Anderson?
Yep, doing well, Peter. Just wrapped up Pitch It semifinal round number 2 a few minutes ago. So that was lots of fun today. Lots of good companies in that competition.
All right, very exciting. And Andrew Dix back with us for the, 7th, 8th, 9th time. How are you doing, Andrew?
I'm doing well, and I'm happy that you keep inviting me back. And I'm very excited about your forthcoming Fintech Nexus I was just talking about with Todd.
Yes, indeed. Anyway, let's kick it off. The news, another very busy week of news. We're going to kick it off with Shopify. Shopify keep adding to their fintech portfolio. You know, they've had payments processing for a while with Stripe. They've got their own lending business. They've got their own checking account now. They've got BNPL. Now they announced this week B2B payments. They're partnering with Melio, the Israeli company, and B2B payments is still a bit of a pain point for many small businesses. And this way, everything's going to be integrated inside Shopify. No need to go out to like a Bill.com or whatever, and it's going to be free for merchants for the most part. So Shopify just continuing to execute. It seems really, really well. What do you think, Todd?
Yeah, shameless plug. We have Shopify and Melio. Speaking about this at the event coming up on May 10th and 11th. Get your tickets today. So, yeah, I mean, I think it's a natural evolution of Shopify's continue, move into, better tools for the businesses that use Shopify. They started off as basically a website provider. And now they have a checking account. I don't think they call it a checking account, but they essentially have a checking account or a checking-like product. Now they do this partnership with Melio. So if you're on Shopify and you're a business that uses Shopify, you don't have to go elsewhere. To get some of these tools, and the more they integrate with that, the more they keep people. It's what this theme that we've been talking about for a while now. It's kind of these ecosystems, and it keeps them in the ecosystems versus having to go outside of the ecosystem to get something. So I think it's a natural and a smart evolution for Shopify.
Indeed.
Andrew? Yeah, I think it's hard to add what you just taught. It's just part of the thesis of fintech everywhere. Either you do it yourself, you partner with somebody to offer it, or you concede defeat. Because over time, people want to deal with fewer and fewer platforms. And you need to make your service simple, convenient, and easy for your clients, your customers, and consumers. And that's what everybody needs to do. And we're just going to see more of this over time.
Yep. Yeah. Well, speaking of more of this, our next news item is about Wise, formerly TransferWise. They're obviously known for their cross-border payments type offering, but they've now got what amounts to an account, an FDIC insured account. We're doing this with JP Morgan, which that surprised me. But they're offering 3.92% interest. This is on people who have money at Wise. Some people are using them a lot, and they'll have actually an account there at Wise. So until recently, you weren't going to get FDIC insurance. Obviously, the events of the last 7 or 8 weeks have made FDIC insurance top of mind, and now Wise have come out with a product that is for their customers in their multi-currency accounts. This is accounts that can go off and do and send money in multiple currencies. But
we've lost Peter.
We lost Peter.
I think I'll pick up the baton there. I think I think for Wise, especially as a company that started in the UK and Europe, I think it's a smart move to make a bigger imprint in the US. because U.S. customers obviously are, especially as Peter mentioned, the last 7 or 8 weeks, more attuned to FDIC insurance. The move, I think, is a smart one for them to acquire more U.S. customers, which I don't know where they're at on that journey. But it's to me, it's a smart move and a little surprising, as Peter said, with JP Morgan. But I think it's it's an interesting move by Wise, that it's probably a way for them to maybe make a bit of a name for themselves in the U.S., where I don't think they have the biggest name recognition to date.
Yeah, I love Wise, and I've been a customer of theirs using their services for years now. And when I stumbled upon it many years ago, I fell in love with it. And watching them evolve, I've always considered them to be a bit of a stealth bank. And they're offering similar, services in Europe, UK, to provide a return for individual accounts. And I think that was a smart move. At the same time, I think they're late to the game. I think this is something they should have done years ago. They have had IBAN accounts for many years. People park cash on their platform and all the different currencies they utilize. This is something they should have executed upon a long time ago, because competition is increasing. You see that Apple has their savings feature, and Apple is now the largest fintech in the world, I think. Lending Club offers a pretty awesome rate too. In an environment like this, you got to be aggressive. You got to push forward. And I think, Wise is still in the game, but I think they need to pick up pace and up their game.
Speaking of upping their game and taking on one of the biggest behemoths out there in the U.S. government and the regulatory regime, and I'm sure, Andrew, you'll have some interesting comments here. But our next story talks about Coinbase suing the SEC over the rulemaking petition. Basically, Coinbase wants to get answers on kind of why the SEC has taken some of the actions and done some of the things they've done in the last year and in recent months. And what's been frustrating to a lot that either watch fintech like myself and Peter and even Andrew is it just seems like a lot of this is secret, and then all of a sudden it's all right, this is our decision and that's final. And it's very much combative with a lot of the crypto industry, and it's only increased so after the FTX scandal. And I think there's a lot of people in Washington who are probably mad that they got that hoodwinked in a way by SBF and are taking it out on a lot of companies. But Andrew, what are your thoughts as someone who knows a lot of people in Washington and always have done a great job on kind of this type of story? What are your thoughts?
Yeah. So obviously when Coinbase received the Wells notice, that was, not a good moment for the crypto exchange. And they just posted the response to the Wells notice today. That being said, I think that they have a good argument, but it's also one that's hard to win when you're battling a government entity that effectively has unlimited resources. That's always a heavy lift. In the response that they posted today, they start out with the fact that their initial public offering, the registration statement, the S1, was approved by the SEC. Why would the SEC approve them as a public company if they thought what they were doing was illegal? How do you level that? I think that's a heavy lift for the commission. But at the same time, they've shifted from, hey, Congress, you need to create rules, to, well, we don't need new rules because everything's a security. And I think there's just a lot of politics in play there. I think Gensler, he is in bed with some, pretty influential people on Capitol Hill who do not like crypto. One being Elizabeth Warren, and he's a guy who plays long ball, and so he's playing his cards as he thinks he should. And I think we're going to see, an interesting battle. Coinbase was recently in the UK. Brian Armstrong and his team, they were there talking to regulators. And then they stopped back in Washington, D.C., and they visited with the commission. And you see them considering all their options. Should duke this out? Should we move to the UK, or should we move to Europe? And the last two are more accepting jurisdictions when you come to digital assets or crypto assets. So I think it'll be interesting to watch.
To this point, it's a shame it's gotten to this point. And Peter, we're talking about the Coinbase story and kind of them suing, and Andrew was referencing the Wells notice that Coinbase responded to with if you had a big issue with our business, then why did you let us go public, basically?
Right.
And I think that's a fair question from the exchange. What are your thoughts?
Well, I don't know if Gary Gensler was in charge during the whole S1 filings that they, and the environment was, and so I don't think he might not have wanted them to go. He might not have approved the S1 filings. So it's, it is basically, I think it's inevitable that Coinbase leaves America. And I think they're, while we have the current administration, it's hostile to crypto. We've still got another 2 years, 2.5 years of that. So, it's not good if you're a crypto company in the US.
So we're going to stay on crypto. And the next story is, Binance says they're no longer buying Voyager Digital. They had, this was a pretty big deal when it was first announced. And there was a lot of hoopla around it. Many, Binance had been acquiring a lot of room in the space. The Voyager deal was very much thought of as a big moment for Binance, but now they're saying the deal's not going through. And I think part of this, and I'd love to obviously get your guys' thoughts, is they have always been operating, considering they are offshore, kind of outside the purview of regulators. And the more that they acquire in terms of businesses, they put themselves right in the bullseye zone. And I wonder if that plays into this. I think one of conversations we had this week is, is their balance sheet really as good as they say it is? Can they actually acquire Voyager anymore? And so there's so much that's like secret with Binance. We really don't know the real motivations here, but a couple of interesting paths that we can kind of pull on here. Peter?
Yeah, I think Binance, this was a big deal. Keep in mind, this was December, right after the FTX blow up. The Voyager was, the 3 hours, they were exposed to 3 hours capital, and they really, they weren't no longer a going concern. Binance swoops in and says, yeah, we'll give you $1 billion and we'll rescue you. And because they're the only big, exchange left standing apart from Coinbase. And, I think they have now gotten cold feet. And I think, they blame the regulatory environment. I just wonder how much they ever really intended to go through with this. That's what do you think, Andrew? I'm just curious.
So you think it was a trap? Is that what you think?
Well, I think they did it. They did it, but I'm just wondering how much they were fully on board with the acquisition from the get-go.
Well, it's interesting. I hadn't thought of it like that, but I got to.
It's such a hard company to read at many times.
It really is. They are so opaque.
Well, yeah. Well, Binance is opaque. Binance.us is a US-based company and somewhat shielded from the bigger Binance. But I think that Binance West, they realized that they were overpaying. Maybe they should have been paying zero for something that they didn't really need, and
exactly.
And I in the end, it was probably the right decision by Binance US to exit it. And Voyager is now winding things down, and they're going to return assets to the customers. And the big mistake is on Voyager's end, who happened to loan $650 million to 3 Arrows Capital, which happened to have a lot of exposure to Terra USD, which happened to be a stable coin that was not very stable. And the house of cards collapsed rapidly. And when the tide went out, we could see who wasn't wearing any clothes. And it's kind of a sorry chapter in the odyssey of crypto.
Well, now we're gonna move. We're gonna move away from crypto into the personalization space. Klarna announced they're offering a new AI-powered shopping feed. This will help boost business. They also announced the Chat GPT plugin. I think it was last month that they announced that. So the new discovery feed gives highly personalized recommendations, and this is obviously a move that a lot of the digital bank players are making in terms of, if you're gonna have this customer base, it can't just be here's an offer that 1 million people get. Banks are starting to play in this space a lot more as well. As personalization is going to be a differentiator. If not today, then obviously in the very near future. And so it's a smart move by Klarna, and shows they're thinking, kind of more of the long game, at least in my opinion. Peter, what are your thoughts?
Yeah, I think it's a fantastic move. I mean, you think about it. We've been scrolling through Facebook feeds, Instagram feeds, Twitter feeds for what, 10, 15 plus years now. And Klarna have such a big customer base. I mean, I can't remember what was the number. It was 150 million, I think, consumers that, and people, and, particularly people in America, the Western world in general, love to shop. It's a hobby of so many people. So rather than scroll through a feed of your old high school friends, why don't you scroll through a feed of things that you're interested in? And it's just another. I could see it becoming another destination, and obviously the merchants are going to love it because they get exposure.
I think this aligns with the first story we all were talking about, and what you said, Todd, about how adding more services, and and I said fintech everywhere. This just kind of makes sense. I think about Klarna, and they kind of promote themselves as the digital bank in Europe because they do have a banking license across the Atlantic. And in the U.S., I kind of think of them like point of sale, BNPL provider. Them rolling in this opportunity to have direct sales on their own platform is interesting. I think that is an interesting move. I think that it's part of this evolution of providing more better services to your existing clients and customers. And Klarna has a lot of customers, and either you do that or you kind of concede defeat and you get acquired. And as we all know, as you guys know, they, Klarna raised capital not too long ago, and they took a pretty significant haircut.
Yeah.
And they probably sat around the table and said, "Gee, that wasn't cool. What do we do to to right the ship and turn things around?" And doing things like this is how you do that, perhaps.
Yep.
Wasn't Klarna the one that said they'd be profitable in November of this year? I'm pretty sure that they
remember.
Yeah, I'm pretty sure they said that they'd be able to turn, because they were profitable, and a lot of their losses were related to investments they made in either technology or new markets. Now to the portion of the show where we talk about potential bank failures. First Republic is continuing to teeter. We got some numbers from them this week. 102 billion in outflows in March. There's basically been 6 weeks of the crisis, or at least the situation with First Republic, and there's no real viable long-term plan to save the bank. There's been a lot of capital injections and a lot of conversation, but it doesn't seem like we have a steady plan there. And at the end of December, the bank had 103 billion in home loans on its balance sheet. Peter, what are your thoughts on kind of where First Republic sits today? And ultimately, is First Republic this time next year going to still be around?
I'd be very surprised. I think I think they are. I mean, it was like one of the all-time great, horrendous great, I guess, earnings calls, 12 minutes, no questions. They made a profit, but you could say that they have a very big question marks over the way they can operate as a going concern. I mean, they have 103. Like their big thing was these home loans to these wealthy people at really attractive rates. So you're talking, massive jumbo home loans, several $1 million in loans, but they're all at like 2.5%, 3.5%. So that portfolio, which they've kept on their balance sheet, is just worth so much less than it was a year and a half ago when they were doing these loans. Now, if Matt Levine had a great column today, basically saying there's two options for First Republic: do something or do nothing. And he said the best option is to do nothing, but that's a really bad option too, because there's nothing. It's possible they can muddle through, but they're going to have to stop the deposit flight, and they're down. The stock price is down like 95% from February, and
it was up 9% after earnings. I think
it was up today. It was up today.
Yeah.
It was down yesterday. It was up today, and I think it's. I just don't see how they can get out of this. What do you think, Andrew?
Peter, you made a good point there that the share price earlier this year was over $140 a share. And 2 years ago, it was over $200 a share. And today it closed at $6.19 a share. That's just an incredible amount of value destruction. I mean, it's almost unheard of except for a bankruptcy, situation. So, will it survive or not? I don't know. I was reading something earlier today where somebody described the situation is the bank going out to people saying, look, you need to save us now, because if you don't, you're going to pay more later, and upping the fees you're paying to FDIC to cover what we're going to be what you're going to be hit with. And I haven't gone back to run those numbers, but that's kind of a scary thought. And there's a lot of people pointing a lot of fingers at different places. In the end, it comes down to poor management of the bank because they took on too much interest rate risk. And it's also a failure of our regulators who should have been, chasing after these banks saying, this doesn't work, you need to fix this now. And they didn't do that. So I think it's clear that's where the blame lies. Tell me if you think I'm wrong.
Andrew, as the regulatory landscape probably better than Peter and I. I mean, it feels like, even with SVB, there's these like notices that go from the regulator to the bank, but they're secret, or at least they're not made public. I mean, how much would be helped if those things are public? Like, hey, here's a notice from the Federal Reserve to SVB in February of last year. Like, you guys need, there's a concern from us to you, or I don't know if that's legal or not, but it seems like some of this shrouded in secrecy of like, the regulator comes in after and says, well, we sent 6 notices to SVB and we told them, but they didn't do anything.
I think that's a failure on the regulators' part. They have a lot of power. I think we should be these public with their ongoing, because you don't want to create unnecessary fear in the markets. But the regulators, the bank regulators, have a lot of say with what banks do, and they also have access to all this information. And when you start to see this in a rising interest rate environment, you got to be raising that alarm. And that didn't happen. That's also why the Federal Reserve has announced a review or an investigation as to what went wrong on their side, as they should.
Yeah.
Well, more to come on bank failures in the future. Nubank reaches 80 million customers in LATAM. That's up 33% year on year. 80 million across Brazil, Mexico, and Colombia. Added 5 million new customers in Q1. Looking to add new products, boosting revenue per customer. And they recently launched payroll loans for federal employees. And if you want a kind of a poster child for an awesome fintech that knows exactly what they're doing, then it should go right in the dictionary with David and Christina and the rest of the team over there at Nubank, because they are probably arguably the best fintech in the world.
Yep. no, just super impressive how they continue to execute. I think, they are really. I think I agree with Todd. I think the most successful fintech. I mean, they're public now. You can go buy their shares on the New York Stock Exchange. Focus in Latin America, and done. They just know how to execute, and they one of the big knocks on them was that their average revenue per customer was really low. It's like 1/20th the average revenue per customer of the big banks in Brazil, but they're doing something about that. And their customer acquisition cost is so low. It's like 1% of some of the acquisition costs of the US banks. So they continue to impress me, and I think they're doing it carefully. Colombia, Mexico, Brazil. That's all they're in right now. They will continue to go, but they started with Mexico as their first, and they went to Colombia. David Velez is from Colombia. He knows that market well, so I think they're going to continue to do well.
I can't argue with anything either of you said. It's an impressive team. I think I was actually introduced to Nubank at your event in Miami a number of years ago, where you had the CEO speak. Very impressive. This is a situation where demand meets supply. Where you have a lot of old, entrenched, established banks providing crappy service, and you have a young fintech that's sophisticated and has the tools and the horsepower to do something different, and they've done it. And it's just a very impressive operation. And I don't see anything standing in their way right now. You mentioned, Peter, that they've taken a knock for revenue per customer. I think that's actually a good thing, because that's how they're scaling. Is they're not nickel and diming people fees. I still hate my local bank for all the fees it charges me. That's what you got to do. Better service, lower price, then you get growth.
Yep. For
the last story, I actually want to go to a piece that Andrew that you did, and if you could maybe elaborate and tell us a little bit more about the proposed legislation to improve access to capital, including the accredited investor fix and more. Tell us a little bit more about what's been going on in the House, and about the story you wrote on this.
That's thanks for asking about that. It's interesting because I've been following this saga for such a long time. The original Jobs Act was signed into law in 2012, bipartisan, signed by President Obama. It was just kind of a unique time and place that I kind of thought has gone away due to the friction that we see on Capitol Hill today right now. But with the Republicans and Patrick Mahenry specifically taking over House Financial Services Committee, he actually moved very quickly to push forward legislation that he has wanted for some time now. And they held a subcommittee hearing recently on various bills and legislation to improve capital formation markets. And they did a markup yesterday on a whole bunch of these bills. I think there were 15 in total. And the chatter is right now is that they have bipartisan support on a lot of this. And that's vital. If you can get both sides of the aisle to go along with it, you have a far better chance of it making through the House. And I think a lot of these things will make it through the House. Question is whether it'll go to the Senate and just die there. But I think that there's really serious interest from the Democrats to democratize the definition of accredited investor, which is something they should do. They need to have a sophistication qualification. The SEC does not want it. They hate the idea. I don't know why. It doesn't make a lot of sense. And also there's a single piece of legislation that has a bunch of smaller bills that they've kind of amalgamated, and they're looking to do things like bump up Reg A to 150 million, bits and pieces of the accredited investor definitions in there, venture funds. There's all these little things that they should be doing, can be doing, that they are doing now, and they should have done these a long time ago. I think Maxine actually supports a lot of these too. I wish she would have done them during her tenure, but now it looks like we're going to have some legislation get approved by the Financial Services Committee, and it's going to go to a floor vote, and hopefully soon.
Let's hope so. I mean, there's a lot of common sense stuff within some of these bills that it just makes sense to do.
Yeah, I think America just doesn't. I mean, look at other countries. Look at the UK and how they support small business with anyone can invest in a small business through in the UK, and you get tax benefits for doing so. We don't have anything like that here, and I think we should. Capital formation is still really hard for small businesses, and I think. Anything, the accredited investor thing is, like as a non-accredited investor, it's really hard for you to invest in a private company, and that should change. I mean, it's if you can invest all your money on a blackjack table with no requirements, you should be able to invest all your money in a small business. It's similar outcomes.
Well, that's a good place to end right there, Peter. Well, obviously, thank you, Andrew, for coming on the show again. Thank you, Peter. We got you back after your technical difficulties. Okay.
I'll get it fixed for next week.
And obviously, thank you to our viewing audience, whether you've watched the live session or the video in video format, or as we put it out as a podcast. And just a last plug. Before we go, there is less than 2 weeks now to Fintech Nexus USA. So if you haven't bought your ticket, I don't know what you're waiting for. Go to fintechnexus.com. If you're a startup, there's startup pricing. There's all sorts of different pricing and discounts out there. So we're happy to accommodate you. fintechnexus.com. We'll see you in less than 2 weeks. Thanks, everyone.
Thank you.
Thank you, Todd. Thank you, Peter.
Okay.